All right, let's get straight into it. You're here because you know it's time to take control of your financial future. You've probably heard 100 times that investing is important, and it is. But let's be real. Most people don't start because they think it's complicated. They think it's going to take hours of research, spreadsheets, and reading charts they don't understand. But that ends today, because I'm going to show you how to create your own personalized investment plan in minutes. No fluff, no complicated jargon, just real talk. First, take a deep breath. This isn't about becoming a stock market genius overnight. It's about setting up a system that works for you. Not your cousin, not some guy on Instagram. You. Now, the first step, before any money moves, is clarity. You need to know what you're investing for. That sounds simple, but if you skip it, everything else becomes noise. Is it for retirement? Buying a house? Starting a business? Maybe you want freedom, the kind where you don't have to check your bank account before going on vacation. Get specific. Put a number on it. Say it out loud if you have to. I want $500,000 by age 50. Or, I want to retire in 15 years. The more specific you are, the more powerful your plan becomes. That goal becomes your compass. Now, step 2. Know your time horizon. That just means how long until you need that money. If it's less than 3 years, you're not investing, you're saving. Put that in a high-yield savings account or short-term bonds. But if it's 5, 10, 20 years, that's where real investing comes in. Longer time, more growth potential. Why? Because time smooths out the ups and downs. The stock market might be wild in the short term, but over decades, it trends up. That's not optimism. That's historical data. Step 3. Understand your risk tolerance. This is about your ability to emotionally handle the ride. Because here's the truth. There will be crashes. There will be dips. And if you panic every time your portfolio goes red, you'll make bad decisions. Your goal is to invest in a way that lets you sleep at night. That might mean more stocks, or maybe more bonds. There's no right answer, only what's right for you. So let's break it down. You're going to build your portfolio with 3 basic building blocks: stocks, bonds, and cash. Stocks are for growth. Bonds are for stability. Cash is for flexibility. That's it. No need to get fancy. Here's a simple rule of thumb. 100 minus your age equals your stock percentage. So if you're 30, aim for 70% in stocks, 30% in bonds and cash. It's not perfect, but it's a good starting point. Adjust it based on your goal and how much risk you can stomach. Now, we move to step 4. Automate everything. Listen, discipline is powerful, but systems are stronger. You don't want to rely on willpower every month to move money into your investments. Set it and forget it. Set up automatic transfers. Choose a percentage of your income. 10%, 15%, whatever you can afford. And make that your non-negotiable. Don't wait for the right time. The right time was yesterday. The next best time is right now. The market doesn't care about timing. It cares about time in the market. Consistency beats perfection. Step 5. Choose where to invest. For most people, index funds are the best starting point. Why? Because they're simple, low cost, and they track the overall market. You're not trying to beat the market, you're trying to ride the market. Look for broad market index funds like S&P 500 or total market funds. They give you instant diversification and lower risk. And don't forget about retirement accounts. If you have access to a 401k, start there, especially if there's a company match. That's free money. Then, look at IRAs. Roth IRA if you're younger and expect to earn more later. Traditional IRA if you want tax benefits now. Step 6. Review and adjust. Once a year, not every week. You're not a day trader. You're a long-term investor. Check in annually. Rebalance if needed. If your stocks have grown and now they're 80% of your portfolio, sell a bit and move that money back into bonds to stay aligned with your plan. This is where emotional control matters most. Most people mess up not because they pick the wrong stock, but because they panic. They hear bad news, they watch the market drop, and they sell low. That's a losing game. Your job is to trust your plan, not your emotions. Success in investing isn't about intelligence. It's about behavior. It's about patience. It's about consistency. You don't need to be brilliant. You need to be disciplined. You need to show up, month after month, year after year. That's how you win. Let's say you invest $500 a month into a simple index fund with an average return of 8%. In 20 years, you're looking at over $275,000. That's not magic. That's math. That's compound interest doing its thing while you live your life. You don't need to chase hype. You don't need to predict the next big stock. You just need a plan. One that fits your goals, your timeline, your risk, and your lifestyle. That's it. Final piece of the puzzle. Protect your progress. Don't forget about emergencies. Always keep 3 to 6 months of expenses in cash. Because life happens. And when it does, you don't want to touch your investments. That emergency fund is your buffer, your shield, your peace of mind. And protect your mindset too. Tune out the noise. Don't let fear drive your decisions. Don't let FOMO push you into things you don't understand. Trust your process. Focus on your lane. You don't need to be perfect. You just need to be in the game. So right now, you have a goal. You have a time frame. You understand your risk tolerance. You know how to split your money between stocks, bonds, and cash. You know to automate your contributions. And you know to stay the course, no matter what the headlines say. That's your plan. Simple, clear, and personal. And the best part? You built it in minutes. Now go take action.